Okay, Chapter 11 on Social Security and Medicare. Just the end of the chapter, last few slides have some facts on Medicare. Those are very important. Social Security is also a very important resource. It's probably worth about, in terms of retirement readiness, it's worth about 4 times as much as Medicare is. It is a lot more complex, so we're going to spend most of our time doing that. There are some important rules for Medicare that I hope you'll pay attention to. Okay, so Social Security in the United States was started in 1935. It was part of the New Deal enacted by President Roosevelt in light of the Great Depression. Medicare was not added until 1965. That was done under the administration of President Lyndon Johnson, part of his Great Society initiative. Let me go ahead and get a more full screen. You can read, President Roosevelt said we can never ensure 100% of the population against 100% of the hazards and vicissitudes of life. But we have tried to frame a law which will give some measure of protection to the average citizen and to his family against the loss of a job and against a poverty-ridden old age. So Social Security wasn't meant to be such a major part of people's retirement income, but it has become more and more important as people have come to expect a retirement. I think before Social Security, retirement was not something that was expected. It was and looked forward to. It was something that happened when people lived long enough but weren't in good enough health to continue working. That was really primarily what retirement was before Social Security kicked in. You can see here's a quote by President Obama, and he talks about not slashing benefits for future generations or subjecting Americans' guaranteed income to the whims of the stock market. So that's kind of President Bush had talked about potentially allowing people to invest Social Security in the stock market, or at least a portion of their Social Security benefits in the stock market. So the benefits available are retirement benefits, both to the primary income earner, and also spousal benefits are available. Disability benefits are a part of OASDI, Old Age Survivor and Disability Income. Family benefits are available both to living family members of living primary insured people, and also to their survivors. And then Medicare is part of the payroll tax, and we'll talk about that. Supplemental Social Security or Supplemental Security Income, SSI, is something that is more like a welfare kind of program. It's if you don't have enough benefits from Social Security, or if you have hardly any benefits from Social Security, or through disability benefits through Social Security, you can get that. Some facts here on Social Security. Over $750 billion people got in Social Security last year, nearly 60 million Americans. On average, Social Security represents about 39% of the income of the elderly. It's about a 40% on average wage replacement ratio, and we'll look at into some of the math behind that. 90% of retirees are currently getting it, and 94% of current workers are paying into it. At the time Social Security, or around the time that Social Security went into effect, 1940, a person who was alive at 65 was expected to live another 14 years. Life expectancy at birth was only 67, so only slightly more than half of the people actually made it to the age where they could collect Social Security. But contingent upon if you made it to 65 on average, you lived until age 79. Today, the average worker lives about, and this is an average between males and females, about 20 years. Men live till 65-year-old men on average lived at age 84, and women to about 86, almost 87. When Social Security first went into effect, there were over 10 workers for every person collecting Social Security. Today, there are fewer than 3 workers for everyone collecting Social Security, and less than 20 years from now, it'll be about 2.1 workers for every beneficiary. And that 2033 year is an important year because I think it actually may have moved up since this projection was done. But that is when the Social Security Trust Fund is expected to be out of money. So in, I think it's 2016, we anticipate, so just about a year from now, we anticipate that Social Security will start paying out more money than it brings in. Social Security is basically, for lack of a better term, it's basically a Ponzi scheme. It would not be allowed in the private marketplace. People who are paying in now are supporting the retirees. On Social Security, there is a trust fund. David Walker, who is the former Comptroller General of the United States, has a good quote. He says, "The Social Security Trust Fund, you can't trust it. It's not funded." In the 60s, Congress did what they call unifying the budget. And so before, from 1935 until that point, money went into a specific trust fund, and so it wasn't a Ponzi scheme in that we weren't relying on people who were working today to pay the retirees of today and the people working tomorrow to pay the retirees of tomorrow. People paid in, and then money was saved, and then money was paid out. But they did what's known as unifying the budget. Now, from an accounting standpoint, there are IOUs. The government basically borrows money from the Social Security Trust Fund, and there are bonds in the Social Security Trust Fund. But there are projections that Social Security will run out of money in 2033. I think I'd even seen a projection as early as 2031. In which case, if they don't make any changes, they'll be able to pay out is what comes in, and that'll be at that juncture about 76 cents on the dollar. And those are based upon Congressional Budget Office projections. So, Social Security taxes and contributions. We've talked about the payroll tax before in this class. So, the Federal Insurance Contributions Act is FICA. So it's a total of 7.65. That's on the employee side. The employer side is another 7.65. So the 6.2 is for OASDI. That's the Old Age Security Income and Disability Income Trust. 5.3%, we've seen that number before. That's the permitted disparity. That is the OASI. It's for the retirement benefit. 0.9% is for the disability trust. Again, those two added together 6.2%, and those are only up to $117,000, which is known as the Social Security wage base. On your entire income, you pay 1.45%, and your employer matches both of those. So it's a total of 12.4 and 2.9, or 15.3% that goes into the FICA. The supplemental security income is funded by general tax revenue. It's more of a welfare type program. You don't need to really know this because it's not in effect anymore. There was a payroll tax holiday so that you had 4.2 per employees only paid 4.2%. Employers still paid 6.2%. So there was a total of 10.4% going in. That expired in 2012. It was part of the stimulus package after the last economic downturn. President Obama initiated to shore up Medicare. Medicare is actually in worse financial shape than Social Security is. He initiated a Medicare tax on the wealthy, so people who make, for married filing jointly, people who make above $250,000, it's a tax on their net investment income. So it's only on the net investment income, this 3.8%. These threshold amounts are not indexed. So right now it may not affect all that many people, but 20, 30, 40, 50 years in the future, with inflation, it's going to affect millions and millions of more Americans. For single, it's 200,000. Married filing separately, it's 125. It's the threshold. Again, the 3.8% tax only on net investment income to the extent that your modified adjusted gross income exceeds 250. There's also a 0.9% of wages tax, same thresholds, but this is on your wages, compensation, or self-employment income, not the net investment income. So it's paid by not both employer and employee. It's just paid by employees. So potentially you're looking at well, actually we probably shouldn't say that. This portion is just the only portion that's on the wages. And again, just on the portion that for married filing jointly is above $250,000. So here's an example on the high Medicare tax example. Let's assume that person C, single filer, so their threshold is $200,000. Let's say they make $130,000 in wages, an additional $145,000 in self-employment income. So that's a total of $275,000. So they wouldn't pay any on their wages. Typically in these types of problems, what you do is you do your wages first, and then you add your self-employment income. So the next $70,000 in self-employment income would not be subject to the 0.9%, but the additional $75,000, the amount that goes above $200,000, would be subject to the 0.9% tax, and you do 0.009 times $75,000. Here's another example. You can work through that on your own. We would use, rather than the 200,000, we would use the 250. Okay, self-employment tax calculation. So basically, what you do is you take the income after expenses, and you multiply that by 0.9235 or 92.35%, and then you go into multiplying your 12.4. That's both sides of the 6.2 up to the Social Security wage base, and then both sides of the 1.45, the Medicare portion, on the entire amount. The reason that we do the 0.9235 is because 100 minus 7.65, which is half of the employer's half of the payroll taxes, gets us to the 92.35%. So typically, I'll address these questions, and then we'll go ahead and look at an example, and we'll talk about in Excel how this might work. So how is self-employment tax impacted when the taxpayer also has W-2 income? As I mentioned, typically what you'll do, let's take a professor, for example, who might make $100,000, but then might do some consulting on the side in, let's say, financial planning, and make, say, $50,000 on the side. So typically what ends up happening is you do the wage taxes first, because that's already had the employer, whoever's doing the payroll has already taken it out. That person makes, let's say the professor makes $100,000 a year. Then we take the $50,000 portion and multiply it times the 0.9235, and we would come up with something. We'd say, okay, there's a certain amount of that that's above 117,000. We would just take the difference. We would take the next 17,000 and multiply it by 12.4, and then whatever above 117,000, or actually the entire between 100 and whatever the maximum is, and multiply it by the 2.9. So that's generally how that would work. So let's take a look at this. Let's look at an example where we have somebody that makes $100,000, and we take that and we multiply it by 0.9235. So this will make this one the percent, and this $1. Oops, nope, I want that $1. So we'll do that to arrive at what the slide calls A. $92,350, and then we'll take, since we're below 117,000, we'll do the, actually, since we're below 117,000, we'll take all of it, equals, let's see, 12.4 times 12.4% or 0.124 times the full amount. There's my Social Security tax, OASDI, and then I've got my Medicare tax equals 2.9% times the full amount, regardless of how much it is. So we could sum up, here's what the self-employment payroll taxes would be, and there you have it. But now let's assume instead of $100,000 that this person was earning $200,000. So this would be incorrect, because we would, instead of doing times 184,000, that's above 117. So that's going to reduce that. So we only do it on the first 117,000, but we still do this on the full amount that's in cell D1. We sum those together, and this is what a person would be paying in total self-employment tax. That's not income. That's not income tax. That's just payroll tax. Okay. So what is considered, how do you figure out if you're going to get Social Security or not? The retirement benefit, you have to be what is known as fully insured, which means you have to have at least 40 quarters of coverage. 40 quarters, you might say that's the same thing as 10 years, but it's not exactly. If you only work for part of a year, or if you're a seasonal worker, let's say it's a regular thing that you're only working part of a year, then you can earn 4 quarters of credit in let's say 2 months of work. People who go to work in Alaska for you've seen that show, The Deadliest Catch. They make $60,000 for 2 months of work, and then they come back to the lower 48 and live off of what they made. They get 4 quarters of coverage. Migrant farmers who only work during who work most during planting and harvesting season, they're going to get 4 quarters of work. As long as you earn, let's say $4,800, even if you did it in a week, that could get you 4 quarters of coverage in a given year. You can't earn more than 4 quarters of coverage in a given year, though. Now, Social Security, as we'll see, is based upon the highest 35 years of earnings. So you're only going to get a benefit if you've got a paycheck at all if you've got 40 quarters of coverage. But if you only have 40 quarters of coverage, there's going to be a lot of zeros, for the next, as high as 35 years. So there's going to be 25 years of zeros averaged in there. So it's going to bring down your benefit quite a bit. So for the survivor's benefit, it is 6 quarters out of coverage out of the previous 13. And once we get to Medicare, we'll see that is a different, there's a different definition for fully insured for disability insurance, and we'll see what that is when we get there. So the Social Security beneficiaries can be the participant worker, the participant spouse, children, can be their dependent parents. Now the parents have to be declaimed as dependents in order for them to be beneficiaries. Also, a divorced spouse. Let's say that you have somebody that was married 3 times, at least 10 years to each spouse. Each spouse is going to can get spousal benefit, and that will not affect the participant worker's pay. So if up to 3 spouses up before the age of 62 can get spousal benefit, and we'll calculate how spousal benefit works in a little bit. So who gets the retirement benefit? It's fully insured retirees, and they get the primary insurance amount at normal retirement age. So we'll look at what normal retirement age is, and it varies from 65 to 67 depending upon what you were born, and we'll look at a table here shortly. Now you don't have to take your benefit starting at normal retirement age. You can take it before or you can take it after. You actually get credit for delaying it, and you say, hey, say my full retirement age is 66. I don't need it right now. I'm still working, so I'm just going to let it roll. So it will actually increase up until age 70. Or if you retire at age 62, as early as age 62, and you need to take money out, you can receive a reduced benefit before normal retirement age, and we'll get into the calculation of how that's done as well. So here are the ages. I think the key pieces for you to focus on here, see if I can get my mouse, is 66 years. That's what it currently is for people who are attaining normal retirement age now, and have been for the last several years. So, and will until the year 2020. 66 is the normal retirement age. It used to be that it was age 65. As it's currently legislated for me and for you, it's people born 1960 or after, it's age 67, and then it stops. So there's this window in the middle that's the key. 1943 to 54. Memorize that is 66, and know that every year after 54, it increased by 2 months until it gets to age 67. Every year before 43, it decreases by 2 months until you get back to age 65 at 1937. So 42, 10 months, 41, 8 months, 40, 6 months, 39, 4 months, 38, 2 months, and then 37, age 65. You do need to memorize this. So, calculating the retirement benefit. It's based upon the worker's average index monthly earnings. Convert earnings, and it has post age 21. So you don't get these prior to age 21 earnings don't get calculated in, and it's based upon the highest 35 years that it'll be summed together and then divided by 420. Now, how do we get to 420? 35 times 12 is 420 months. So we're looking for a monthly number is what we're going to get to. So but we have to index, and the indexing is based upon inflation. We have to index based upon, and there's this table that the Social Security Administration has that says, okay, this is what the average earnings in the country were during this given year. And so we'll take a look at that. There are some examples that are in the book, but I'm going to show you directly from the Social Security website here. So the National Average Wage Index, now we focus on 2013, it's almost 2015. So the reason that we focus on a 2013 number is because you always use, say, when the person first becomes eligible for benefits, age 62, when you can, as early as when you can take Social Security. We look at 2 calendar years before that to calculate what the index is. So this $44,888.16 is going to be in the numerator, and then we're going to divide that by, let's say we've got somebody who's retiring after 2013, so effectively in 2014. So we'll look at this. So we'll say, okay, they started 79 through 2013 is 35 years. So we'll look at 1979. So this $11,749.46. That's the figure that we're going to use in the denominator, and we're going to come up with a multiplier. So for 1980, this would be the new divisor, so our multiplier wouldn't be quite as high. We're going to multiply the numbers based upon what the clients actually earned to get it to year 2016 dollars. Let's take a look at that. So we said 1979, 11,479.46. So let's say that in 1979 our person earned $15,000. 11,479.46. So we're going to come up with a multiplier, and the multiplier then is, so this is how much inflation is. So we multiply that, and so that's basically like earning $58,000 today. But let's assume that our person had an income that, even after considering inflation, outpaced inflation by 1% times 1.01. So we'll do that, and we'll end up with average index monthly earnings. Let's say that by the time 2013, they end up with 82,000. This last year working in 2013, 82,267.5 was what is, and 50 cents is what they earned. So what we do is we add up all these numbers, the sum of the highest 35 years, and then we divide by the 420. So divide by the 420, and that gets us indexed to today's dollars. Our average monthly earnings, and again we wouldn't count them annual earnings above 117,000, has been, but again in this case this person hasn't, so has been $5,818. Now we take that and we figure we got to use a math equation to figure out how much our person will be getting as their primary insurance amount, which is what you'll get once you reach full retirement age. So we'd say, okay, you get, and these numbers are indexed, by the way, so you get 90% of the first $816. So somebody who makes less than $816 a month has a 90% wage replacement ratio. But you see that that number drops off pretty significantly between $816 in monthly earnings and $4,917. The multiplier is only 32%, so 32% wage replacement ratio. And on the amount that exceeds $4,917, again, we're not going to count what's over the wage base, the Social Security wage base. The amount that exceeds $4,917, then we only get 15%. So you can see that this is what's known as a regressive system. The more you make, the lower your wage replacement ratio. Let's take a look at it for our mock client. Again, somebody who managed to make, by the time they retired, to make about $6,000 a month. So we say 90% times the first $816. Then we say 32% between $816 and $4,917. And on the amount that exceeds $4,917, you only get 15%. So we add those all together, and we would get somebody that this is what their monthly benefit would be: $2,181.87 if they take money at full retirement age. That is 38% wage replacement ratio. So let's take somebody who only earns, let's just say, about $1,500 a month. So somebody who earns $1,500 a month, we would take this and subtract it. And so this person's going to get a benefit of $953.28, which is a wage replacement of 64%. So the lower your income, the higher your wage replacement ratio. This means that the more money that people make, the higher savings rate that they need to have. They need to replace a higher percentage of their income when we're talking about Social Security, and that's assuming that Social Security benefits pay in the future what they're paying today. So see how that works. All right. The maximum based upon, again, this is based upon Social Security wage base being $117,000 this year. The maximum this year for people to get paid is $2,642. And we can go over, this is an example where it's not actually the primary insurance amount of $5,000. The primary insurance amount is $2,000, is what we get, $2,059. But let me see what the average index monthly earnings is $5,000 in this example. So you can go take some time to go back over that calculation if you want. So an eligible beneficiary the worker may receive, and typically we're talking about spousal benefits, 50% of the primary insured amount. So here's how this works. Let's say I have a spouse who takes off some years to raise children and then works part-time some years, and let's say that she only works on 20 years, and a lot of time that's part-time. So let's say that she has more than 40 credits of service, but let's say her Social Security benefit is only going to be $600 by the time based upon her own earnings record. If mine is $2,000 and hers is $600, she's eligible to, Social Security by default will pay her the higher of her $600 or half of my $2,000, which is $1,000. So the default payment to her will be my $1,000. Now, if let's say that her benefit were $1,200, half of my $2,000 would be $1,000. She could take if she retired at age 62, she could, and this is a fairly sophisticated claiming strategy, if she retired at age 62, she could take a reduced spousal benefit, so it would be 50%, and then we would have to reduce the spousal benefit, let's say 30%. So let's say that she would get 35%. It would actually be a little bit bigger reduction than that. But she could get that 35% and take that early until she got to full retirement age, and then switch over to her own benefit, which would be the full $1,200. That's currently available in the system. I think it kind of sounds like double dipping, but that is a potential strategy for when you have both spouses working. I mean, both spouses who are going to receive their own benefit. So we looked at what normal retirement age is. You can, regardless of what your normal retirement age is, whether it was 60, 65, 66, or 67, you could start taking benefits as early as age 62. This, I think in your slides that you have, the permanently reduced benefit, it says 1/180th. I like to use the fraction 0.05% for each month, so for the first 36 months. And then, let's say it's up to 5 years early. So for the next 24 months, it's 5/12% deduction. So you will be tested on this. The formula for reduced benefits for the spouse is actually a little bit more, punishes a little bit more for the first 36 months. So the deduction is $25.36 per month for each month. So let's look at it, and we'll say that we have somebody who is going to retire 42 months early. So let's look at it, and we'll say they're going to take Social Security 42 months early. So 3.5 years. Let's say it's somebody who is going to get Social Security at age 66, and they want to take it at 62.5. So let's look at an example of what that would be, and we'll use. We'll go back to this slide. It's less to erase. So let's say that their primary insurance amount is $5,000 a month. So let's calculate their permanent. This is a permanent reduction. So if, let's say not $5,000 a month. I'm sorry. Let's say that it was $2,000 a month is what their PIA. That's what they would get if they waited until age 67. Instead, they're going to take it 42 months early. So for the first 36 months, it's 0.05% a month. So I take this one and I say equals this times 5 divided by 9. And then I'll take that entire thing and I'll divide it by 100. But I'll do that in a minute. So we'll say, okay, that is so the first 36 months is going to be 20% deduction. That's pretty good math to know. So then let's say the next 6 months to get from 36 to 42 is going to be this times 5/12. And then we'll divide that by 100. So that's 2.5%. What if instead we were looking at the full 24 months? That would be an additional 10%. So the maximum deduction, so 67 is the latest normal retirement age, so 62 is the earliest you can take out. The maximum reduction is 30% for the primary earner. For spouse, it would be a little bit higher. This is how you would do that calculation. Now, software does it for you in the real world, but this I want you to understand how this works, and you will be tested on it. Okay, so if you do delayed retirement, you can take distributions after normal retirement age. So for people who are were born after 1943, so people who are retiring now, people who were born before 1943 are going to already be into their 70s, so you're not going to need to do this calculation for them. So I want you to understand that it's 2/3% per month that someone can get. So that's 8% a year. So if I delay from, let's say, my normal retirement age is 66, someone who delays 1 year will get 8%, who delays 2 years will get 16%, who delays 3 years will get 24%, someone who delays 4 years will get 32% more. And that's a permanent pay increase. And by the way, that spousal benefit, which is 50% of the primary insurance person's amount, is affected by either early retirement or delayed retirement. So what does that mean? The choice to take Social Security early or late is going to last a paycheck that's going to affect the pay for as long as either spouse lives. And let's talk about how this works. So let's say the example for me and my wife. Let's say she claims my spousal benefit. My amount is $2,000 at normal retirement age. So let's say we both take it normal retirement age. I take $2,000. She gets $1,000. If she dies, her spousal benefit goes away. I keep getting my $2,000. If I die, the spousal benefit kind of goes away, but actually my benefit goes away, but hers steps up to what mine was. So that you're going to keep the higher paycheck for as long as either spouse lives. So if you figure that a break-even age might be from delaying from 66 to age 70, might be age 85, 84, 85. The fact is that there are two. It's going to pay as long as as long as either spouse lives. So let's just say, just for simplicity purposes, that the break-even age is 85. So this is what's known as an actuarially fair payoff. You would be delaying until as late as you can. Let's say you'll make all of your money back by age 85. And I think Social Security is designed to be what's known as actuarially fair. So that on average you kind of break even. If you live longer, then you win. If you don't live as long, you lose. But what we're, as financial planners, we're concerned with is making sure that people have a secure cushion to fall back on. So if they don't live as long, they're not as worried about running out of money. If they live a long time, they're worried about running out of money. So I think if we assume that our clients are going to live the average length, let's say they retire before age 70, we should, if they've got enough money, which they should because they're our clients, we should probably at least have the higher earning spouse delay until age 70, assuming that the spouses are in good health. Let's just assume that they're in average health. We might know that they're in above average health, in which case that would make it even more advantageous. So let's take a look at this. So what does a life expectancy of age 85 mean? It means that half the people, what's the probability of being alive at age 85? It's 50%. Half the people are going to live longer than that. Half the people are going to die before that. So I've got a 1 in 2 chance of one spouse living that long, and I've got a 1 in 2 chance of the other spouse living that long, 50%. I'll go ahead and put those percentages up. Okay, so what are the chances that both spouses will be alive at age 85? Well, if you know anything about statistics, all we have to do is we say, okay, basically it's the same thing as getting 2 heads in a row. What's the chances I get 1 head, 1/2? Okay, so I can get, basically, all I do is I multiply the chances of 2 living are equal this times this. So the chances of both being alive at age 85 would be 25%. The chances of both deceased, I'll say deceased because it sounds a lot nicer than dead, is the same thing. You got a 50% chance to be alive, a 50% chance to be dead. So this equals this times this. And the chances of just one alive past age 85 equal what's left, right? So I got a 25% chance of both, 25% chance of neither, and I got a 50% chance of at least one of them. Really, basically what that means is the chance that the husband's alive and the wife's dead, 25%, and the chance that the wife's alive and the husband's dead. Now, this is ignoring things that we know that men die a little bit earlier on average. So, this is, but just to keep things simple. So, let me ask you, what is the probability that at least one spouse is going to be alive? Well, chance of one is 25%. The chance of both is 75%. So I got a 75% chance to live until life expectancy. That means that it won't decline to 50% chance of at least one, probably until age 89. So joint life expectancy is longer than individual life expectancy. So what does this mean? This means for spouses, 265-year-old people, on average, you're going to win by delaying the higher earning spouse, because the Social Security tables and the costs for that is based upon a single person. So this is how is based upon the odds of a single person making it that long. But when you're doing planning for spouses, this is what you need to do. So also which one is going to go away? So what's the chances of at least one person dead by age 85? Well, it's the same thing as the chances of both deceased plus the chances of just one alive. So it's also 75%. So on average, the first person is going to die before 85. Maybe it's going to be on average at age 82, 81 or 82. So that benefit is going to go away sooner. So the lower benefit is going to go away sooner. The higher benefit is going to last longer on average. So we should take the one that's going to go away sooner as early as possible, and we should take the one that's going to last the longest period of time as late as possible. Makes sense? So the lower earning spouse should claim as soon as possible. The higher earning spouse should claim as late as possible. That is often referred to, and it depends upon when the people retire. They might not retire until then, but that's often known as the 62-70 split. So I want you to understand these sorts of strategies. Okay. Get back to early retirement. Okay. Hopefully that made sense to you, using a little actuarial science. So here's what we're showing is that, yeah, you can see that for somebody who's full retirement age, again, people who were born after 1954, full retirement age is age 67. So you can only delay until 70, regardless of when you're. And actually, this should be NRA, normal retirement age. Those terms technically, normal retirement age is Social Security, full retirement age is in qualified plan documents. It means the same thing though. So 24%, and then we could see that if it was 0.5% a year for the first 3 years, it's 20% discount 3 years early, and then 5% discount a year after that. Okay, and you will be asked to, you will definitely be given problems on this. So, what else can reduce Social Security other than retiring early? If you retire early, take Social Security before normal retirement age. Some people say, hey, I want to get my Social Security check in and keep on working. There is an earnings limitation test. And so if you earn above a certain amount, there starts to be an offset. And we'll look at what that offset is about. And then also there is, the more you make, the higher percentage of your Social Security that's included in your taxable income. People who hardly make anything, none of their Social Security is taxable. So we'll look at those thresholds and see what that means. So people who retire, so early retirees, this is what we mean is claiming Social Security before normal retirement age. So if you continue to have earnings, that's wages and self-employment income, earned income, actually going to work. For anything that you make above $15,840, and I don't think you have to memorize this number. I think it's on that handout that we showed. But you should know that there's a $1 reduction for every $2 above that. So if I make $16,480, I'm going to have a $500 reduction in my Social Security benefit. Now, that reduction is not permanent. It is only until my earnings drop below whatever the threshold is in the future. It will be indexed going up. So 2014, it's $15,480. So that's for years before normal retirement age. In the year, the calendar year, taxes for individuals are based upon calendar years. The retiree reaches normal retirement age. There's a $1 reduction for every $3 of earnings above $41,400. So in that year, it's not as severe, and the threshold is much higher. So what does this mean? If somebody is intent on taking Social Security at normal retirement age, they should understand that they're going to have an offset if they earn above $41,400 in that year. So let's say that their birthday is in October. Now they won't be getting Social Security for very long, just November and December. But there will be an offset. Let's say they're more likely to make above $41,400 in 10 months. So for that individual, it may make sense, even if they stop working in October, to delay their first Social Security paycheck, because again, it will go up 0.2% per month permanently forever, until January 1st of the following year. That's really when, if people are continuing to work, the earliest that they should take it, unless they are terminally ill or have some condition that leads you to believe that they have very likely a pretty short life expectancy, you should probably wait. If for people who are working, again, also unless they absolutely need the money, should probably wait until the January 1st, until January after they turn the age of normal retirement age. So for somebody who's turned 67, let's say in July, they should probably wait until 67 and a half. After attaining normal retirement age, the year after that, then there is no reduction. There is no offset of earnings. So you can, if you take Social Security early, again, that's a permanent reduction, but you can say, no, stop it, I think I've made a mistake. And then they will say, okay, we're going to start the clock. It's going to start growing again. So you want, let's say you started it at 67. You said, oh, and at age 68, you said, oh, dang it, I wish I'd waited until 70. You stop taking the payment, so you've got 2 years remaining until 70. It grows by 8% each year. You get 16% raise by stopping your paycheck for 2 years. So you got to fill out a form. I'm not going to ask you what that form is. There is a one-time thing where you can actually say, I can give back up to 12 months of paychecks as if I'd never received them. So in the example that I said, I get to 68, I could say, actually, if I've only gotten 12 months of paychecks, I could say, I wish I could redo it. You can only do that one time. It used to be that you could do that over and over again, and you could do it all the way back to normal retirement age. Not the case anymore. That's what this means, the true benefit of an interest-free loan. So it used to be that you would just pay the money back. You take the money, use it, you deposit in a bank account. You say, oh, I meant to not take that. Let me give you that money back. And so you let that money accumulate for 3 years, keep the interest, pay the money back, and then at age 70 say, okay, now give me my 24% raise, right? So that was manipulating of the system that they said, nope, we're not going to do it. I wish they would still allow you to do it, but just charge you a little bit of interest because I still think it's very valuable for people to be able to do. Okay, how much of Social Security is taxed? Until 2001, none of Social Security benefits were taxed. Now, it depends on how much you make. So they look at modified adjusted gross income. So we add back, let's say, municipal bond interest and foreign earned income on which you've already taken, let's say you've gotten a credit for paying those taxes. So we add that back in. So for married filing jointly, it's the same thing for single, but I'm going to do the example for married filing jointly. For people whose modified adjusted gross income, not including Social Security, plus half of Social Security. So let's say my modified adjusted gross income is $25,000, and I've got $12,000 in Social Security. So I add the 6. So I do 25 plus 6 equals $31,000. For people who married filing jointly, below the $32,000, none of their income is taxed. But let's say 25,000 plus 20,000 of Social Security, add that adds up to 35. That falls between the 32 and the 44. It's in between the two hurdles. So up to 50% of your Social Security can be taxed. And then above the 44,000, again, MAGI plus half of Social Security, above the 44,000, up to 85% can be taxed. Now, I'm going to give you some complicated rules, and they give it to you in the most complicated way, but then there's a simpler way to do this calculation. And again, this is a calculation that is test worthy. So you will see this on your exam. So, taxation of Social Security. For people who fall in between, MAGI plus half the Social Security is in between, 32 and 44 for married filing jointly. The taxable amount of Social Security benefits is 50% is included in the taxable income, or 50% times MAGI plus 50% of the Social Security less the hurdle 1 value. I could do this calculation for you, but you're going to see in a minute why you're glad that I didn't, because this one even gets more complicated. For people who earn above the second hurdle, up to 85%, so no more than 85% of Social Security benefits can be included. Then it is 85% of times modified adjusted gross income plus half of Social Security less minus 4. So the amount above above 44,000 is times by 85% plus 6,000 for married filing jointly. Well, that's half of the $12,000 difference between 32 and 44, or the tax amount calculated on the base of the 50% formula and only considering hurdle 1, this calculation here. So for these people, you've got to do a whole bunch of either-ors, and man, none of this is going to make sense unless I do an example, but I don't want to do an example the hard way when I can show it to you. Not easy, but easier way. So here's the deal. Here's the alternate method. A equals the excess of MAGI plus half the Social Security benefit over the first hurdle. B equals the excess of MAGI plus half the Social Security benefit over the second hurdle. Okay, so let's look at an example, and then we could do the taxable amount is equal to the least of these three, 50% times A plus 35% times B, or 85% of the Social Security benefit, or 50% of the Social Security benefit plus 85% of B. Ugh, that is painful. Okay, let's look at an example. All these things get clear when we look at an example. Assume that Beth and Bill, so again we're going to use the 32 and 44, have regular income of $35,000 plus muni income of $5,000. So that's going to get added back for MAGI. So MAGI is 40, and they receive Social Security benefits together of $30,000. So I add half of that, and so I got MAGI plus the Social Security benefit equals $55,000. So let's take a look at that, $55,000. So the taxable portion of the Social Security benefit is I earned $55,000. So basically I take this $55,000 and I subtract the 32. So the amount for A that's in excess of 32 is $23,000. B, the amount that 55 that's in excess of 44,000, the upper hurdle, is 11,000. So I'm really just taking 55, subtract 32, and I get the 23, because I've already figured this out, right? MAGI plus half A equals that. So this is already A. So 55 in excess of 32, 55 minus 32 is 23. 55 in excess of 44, 55 minus 44 is 11. So now I just plug it in. I can do 50% of A. By the way, if you're making your note cards, this would be a good thing to put on your note card. I do 50% of A plus 35% of B, so equals 11,500 plus 3,850 equals $15,350. So that one's pretty cheap. Or 85% of my Social Security benefit. 85% of the 30,000 is 25,500. So that's the maximum that it could be. So far, the 15,350 is better. Or 50% of the Social Security benefit plus 85%. So plus 85% of the amount that is above the upper hurdle. So 85% of the 11,000 is 9,350. 50% of 30,000 is 15,000. Add those together, I get 24,350. So I choose number 1. This seems like it would be a very good bonus question on the final exam. Disability benefits. So who is it payable to? People with severe physical or mental impairments, which then prevents them from performing, in quotation marks, substantial work. What substantial is basically anything. If you can't hold a job, then cannot perform any gainful work. This could be payable at any age, but you have to be fully insured for retirement benefit, 40 quarters, fully insured for disability, 20 of the last 40. 20 of the last 40. Okay. Benefits payable to the family members. So I can get a spousal benefit, as we talked about, and spouses can claim that starting at age 62. Spouses, if they're caring for a child under age 16, so you normally get a penalty. So I have to be of full retirement age, but or normal retirement age. But if I have a spouse whose job is to care for a child under age 16, they can take spousal Social Security early without the reduction in benefits until the child turns age 16, or caring for a child who is disabled before age 22. an unmarried child, no, this is if I'm dead. So this family benefit is if I'm dead. So an unmarried child under 18, and then or under age 19 in high school, or age 18 or older and disabled before age 22. Okay, so again, the kid gets paid if they're disabled. So that's what this bottom bullet means. What these two bullets together means is if you retire, let's say you retire, you are smart and graduate at 17. They will pay you until your 18th birthday. Let's say you got held back and you don't graduate until 20. Well, they're only going to pay you until age 19. So, and only if you're still in high school. If you graduate, if you turn 18 in February and then graduate in June, you're going to get paid until June. So that's how that works. Survivor's benefits. So family benefits, unmarried child's not getting benefits if I'm alive. So this one really falls under here. So the widow or widower, this is the only consideration, can get money, can get benefits starting at age 60, not 62. This is the one exception. It's not tested all that often in terms of what the benefit would be, but understand they could get it starting at age 60. They could also get it if they're over 50 and disabled, caring for a child under age 16, so forth and so on. So these are the rules. I would pay attention to the 60 and older because that's the one that is the exception to not being disabled but being able to get benefits before 62. A death benefit, $255. This was one of those benefits that came out in 1935, and $255 would pay for a casket. Today it will not pay for a casket. So there's a limit on the monthly Social Security benefit. I'm going to go ahead and pause here because I think this recording is getting a little bit long. So we'll pick up with slide 40 in the next recording.